All right, we will go ahead and get things started, and we'll allow more people to trickle in. But today, you will be hearing from me. I am Drew Barnes. I am the head of financial planning here at Traction Financial Partners. And a big part of the financial planning that we do for clients is tax planning. So I think most everyone can agree that we always want to try to limit and save taxes. And today we're going to cover a broad array of topics that kind of dive pretty deep into a lot of areas where we can certainly help save in taxes. So not every strategy that we go through today, of course, will be applicable to everybody. Everyone's situation is different. So that's why we wanted to cover a lot of different topics. So hopefully some of these topics will apply to all of you, but of course, everyone's situation is different. And before we dive in, of course, we are very engaged and involved in tax planning on behalf of our clients. We are not tax professionals or CPAs. So we do like to coordinate with our clients' tax professionals and of course, get their kind of sign off on all of our strategies. So everything we review today, you definitely want to be sure to cover with your tax accountant to make sure it's an appropriate strategy for you. Okay, so today, here's our agenda. We're going to look at the basic tax information for 2024, including tax brackets, and just kind of set the stage as we move through our strategies. So you will all probably know which bracket you fall into. So keep that in mind as we move through this, because a lot of these strategies, we want to try to avoid things like tax bracket creep, where, triggering a little extra income could push you up into a bracket that we want to try to avoid. So a lot of our strategies will be to lower that taxable income to make sure we're not jumping up a tax bracket. We'll then look at tax efficient portfolio management approaches. We're, of course, with most of our clients, we're helping to manage their hard-earned savings in their portfolios. We always want to strive to do so in the most tax-efficient manner. We'll then look at tax deferral strategies and ways to defer taxes, which again, deferral and savings are different. So deferring taxes does not mean that you won't one day owe taxes, but the idea is to defer taxes when you're in a higher tax environment, and then later on trigger those taxes when you're in a lower tax environment. We'll then look at some charitable giving strategies. There's a lot of neat ideas that we'll run through in that section. And then we'll wrap up with just a handful of other additional strategies that are hopefully worthwhile. So let's go ahead and kick things off. Here is just a historical graph going back to 1954 of the maximum capital gains and ordinary income brackets. So it's pretty fascinating to see where things once were compared to where they are now. I think all of us want to pay less in taxes, but in the mid to late 1950s and all the way into the mid 1960s, the top marginal bracket was a little north of 90%. So we're certainly not in that kind of environment. And even back then, capital gains were still much lower at about 25%. And historically, capital gains have always been lowered to incentivize investment so that folks are not just sticking the money under the mattress, but are investing in things that will appreciate over time. And so as we can see, certainly for ordinary income rates, they've trended down over time. So in the mid 1980s, they actually for a few years here collapsed the ordinary rates to the same levels of capital gains. So that was when you really saw an explosion of things like non-qualified annuities, because you weren't, if you didn't want to put money into annuity, you'd have it in just a taxable investment account, but a capital gain was the same as ordinary income. So it made a lot more sense for certain strategies. So as we move through, a lot of these strategies are always a byproduct of where tax brackets and tax law is at any given time. That's one thing we don't know into the future, is what will happen with tax rates. So, any tax planning strategy, we want to project out to the future, but there's always some unknown. So this is an ongoing process and something that we always want to be sure to revisit, because tax law is certain to change over time. And then here we are now. The top bracket is, and you can see in the footnote here, it includes the 3.8% tax on net investment income, also known as the Obamacare tax. So if you include that 3.8, the top ordinary income bracket today is 40.8, so it's 37% plus that 3.8. And for capital gains, it's 23.8. So there's a top bracket of 20% for capital gains, and then the extra 3.8. So again, while we all want to pay lower taxes, historically, we're actually in a relatively lower tax environment, certainly than we once were. Okay, so for 2024, just to, again, set the stage, here's our tax brackets for single, this is ordinary income we're looking at. So for single filers here, married filing jointly, that's going to cover the bulk of everybody. There are some heads of household and married filing separately, and then estates and trusts. So you can see, while we're on this topic, estates and trusts get to that top bracket very quickly at $15,200. And this is, not a revocable trust. This is an irrevocable trust. So that's why if you do have any kind of irrevocable trust, you really want to be tax efficient within those, because you're in that top bracket at not a lot of income there. But most folks are going to be in the single and married filing jointly. And in late 2017, going into effect in 2018, they passed the Tax Cuts and Jobs Act. And it really condensed a lot of these tax brackets and expanded a lot of these tax brackets. If you look at married filing jointly here, you get out of the 12% bracket at $94,300, and 22 and 24, so not much of a difference there. You got to get all the way up to $384,000 essentially to be up into the 32% bracket. So that gives us a lot of wiggle room here in these relatively less onerous brackets. And when we look at long-term capital gains, so if you have investments that are not in retirement accounts, or if you have property or anything like that, if you sell those for more than you bought it for, there's a capital gain. So there actually is a 0% rate. So if you're married filing jointly and your taxable income is less than $94,000, you have 0% to pay on capital gains. So that's pretty nice. And then 15% all the way up to $583,750. So most folks are going to be in that 15% range. And we'll see here on the next slide when that 3.8% net investment income surtax kicks in. But if you're up here in a really high bracket, that's when you jump up to 20%. But again, 20%, much lower than 37%. So still incentivizing investment. And all same goes for qualified dividends. So qualified dividends, there's a few things you need to meet, but most holdings, like most stocks that you own that are paying dividends, if you've owned the stock long enough, most of the dividends they pay will be at this qualified rate. So taxed the same as capital gains. And then part of that Tax Cuts and Jobs Act is what was essentially a doubling of standard deductions. So standard deductions are very high. Married filing jointly at $29,200 for this year, single $14,600. So a lot of folks that used to itemize deductions, especially if you're married, you no longer can, because it takes a lot of itemized deductions to be able to get north of that $29,200. Okay, so this is a big one that most folks don't really pay enough attention to. It's the net investment income tax, that 3.8%. If you're single and you have modified adjusted gross income of $200,000 or more, then that's when the 3.8% kicks in. It's applied to the lesser of net investment income or the amount of modified adjusted gross income over $2,000. So if you have $220,000, you're not going to, a modified adjusted gross income, you won't owe that 3.8% on too much. But again, if we can save 3.8%, we want to try to. It's $250,000 for married filing jointly. And then just so you know what qualifies as net investment income, it's interest, dividends, non-qualified annuity income, passive business income and rent. So if you have rental properties, and then capital gains. Okay, so let's dive into tax efficient portfolio management strategies, because what really matters to us as investors is our net after tax return. It's great if you have a 20% return, but if you're paying a boatload of taxes, you're not keeping that full 20%. So we want to be really efficient in how we manage portfolios and strive for the highest tax after tax investment return that we can. So one way we do this is through asset location. Asset location, not to be confused with asset allocation. Asset allocation is what is your portfolio made up of, in terms of cash and bonds versus stocks, large caps versus international stocks. Asset location is where are we placing these different types of securities. So again, this doesn't apply to everybody because not everybody has retirement accounts and after-tax investment accounts. But for those who do, we want to try to place these higher income producing securities in those tax deferred accounts. So retirement accounts, non-qualified annuities, to where they're tax deferred, any interest, dividends, or capital gains within those accounts are not taxed to you on an annual basis. So if because we like high income generating returns, but we want to try to insulate you from those taxes if we can. So the three kind of main areas there are actively managed mutual funds. So an actively managed mutual fund is required by law to pass out capital gains within the fund to the holders of those mutual funds. So whether or not you sell from that actively managed mutual fund, you may owe capital gains. So I always like to bring out the 2008 example, 2018 example. The market dipped about 18% all in January. So throughout the year, all these funds, these managers are buying and selling stocks throughout these funds, and they have a bunch of embedded capital gains in the fund. Well, December, the stock market drops 18%, and we end the year with negative returns, but these funds are paying out distributions, capital gains distributions. So you owe capital gains tax on a fund you didn't sell when you lost money. That's kind of the worst case scenario. That's phantom income that we don't want. So if we do here at Traction, utilize some actively managed funds, we put those in IRAs. We want more tax efficient, as we can see here when we get down to it, passively managed funds in taxable accounts. High yield bonds, and again, this doesn't mean we don't want any high yield bonds ever in our taxable accounts, but right now high yield bonds are yielding around 7 to 8%. So at such a high yield, it's nice to have that income being generated in a retirement account where you're not paying tax. And same goes for real estate investment trusts or REITs that pay high income as well. If we can, we want to shelter those in those tax deferred retirement accounts. So more tax efficient securities, we want those going into our taxable account. So if you have an individual investment account or a joint account or a revocable trust account, or even an irrevocable trust account, that's where we want to be more tax efficient. So we want passively managed mutual funds and exchange traded funds or ETFs that are not going to pay out those year-end capital gain distributions, because they're simply trying to, when we say passive, there's not a manager there deciding, yep, we want to buy this stock and sell this stock. No, they're just trying to match an index like the S&P 500. So they can do so in a very tax efficient manner, and they're not going to pay out those capital gain distributions at the end of the year. Theoretically, it's possible that they may sometimes, but we practically never see it. We want to get municipal bonds in these accounts because municipal bonds are paying us tax-free interest. So if you have taxable accounts, we likely have municipal bonds in there. And then individual stocks as well. We don't, here at Traction, recommend individual stocks too often, but individual stocks are paying those qualified dividends, like I mentioned earlier, which are taxed at capital gains rates, and they're definitely not paying any kind of capital gain distribution like a mutual fund might. So While this is a great practice for everybody, it of course is best for the folks that are in the high tax brackets that are going to benefit the most here. So here's an example of asset location. So we have someone who has a traditional account, a Roth account, and a taxable account. So a traditional account is just an IRA in this example. So this person, we'll say, wants about 50% in stocks and 50% in bonds. So we can put all of our bonds in the IRA account, not pay any tax on that interest. We can take the remainder of the bonds that we want to get to 50% of the total portfolio and put half bonds, half stocks in our Roth account. And then we can have 100% stocks in our taxable account. So that way, any dividends being paid here are those qualified dividends. There's no capital gain distributions from any kind of funds. And then we're not having to generate taxable interest from bonds in this account. So this is from a study done by Vanguard. And you can see here, how does this affect our after-tax returns? About 0.05 to 0.3% per year. And in a case like the one above, it saves $74,000 in taxes over a 30-year period. And what it doesn't also show is if we're saving $74,000 in taxes, that's money that's remaining invested and also growing for us as well. So that $74,000 over the course of time is compounding for us. So we're saving $74,000 in taxes, but that's also growth in our portfolio on top of that $74,000. So in this example, it's a 30-year investment period, 50-50 stock and bond mix. In the tax-deferred account or the IRA, we have $400,000. That was all bonds. In the tax-free account, the Roth, $200,000. That was 50% stocks, 50% bonds. So now we have our $500,000 or 50% in bonds. And then this $100,000 here, combined with the $400,000 in stocks in the taxable account, we get to our 50%. So again, if you have a portfolio where we want to try to manage it to, we'll say something like this, 50% bonds, 50% stocks, and you have multiple account types, we want to try to get the more tax inefficient or income producing investments in those IRAs and the more tax efficient investments in the after-tax accounts or those taxable accounts. And just for some additional information, it's assuming 35% is being withdrawn off this portfolio over this period of time, and that this person's in the 15% long-term capital gains bracket and in the 22% marginal bracket for ordinary income. And I didn't say this when we were looking at the capital gains rates, but those capital gains rates are for long-term capital gains, meaning you held the asset for at least a year and a day. If you sell something in less than a year at a gain, that's a short-term capital gain, which is taxed at ordinary income rates. So unless we have to, we always want to try to hold an investment for at least a year to get us over into the long-term capital gains treatment. So asset location can have a big impact on taxes. The other thing, and for those of you who have taxable accounts with us, have probably realized a lot of this over the last couple of years, is tax loss harvesting. So tax loss harvesting, that's when we intentionally sell a security to realize a capital loss. We immediately take the proceeds and we invest it in a similar investment so that we're maintaining the allocation that we're striving for, and that when the market eventually recovers, so too does your portfolio. But we were able to capture that loss. And that those capital losses are used to offset capital gains. And if there's not any capital gains to offset, then those losses will carry forward with us indefinitely. So there is never a bad time to capture a tax loss in an investment account. Even if you're not going to use it in the next 5-10 years, that's fine. It's going to be used at some point. And if you don't, you can use $3,000, as it says down here. $3,000 of realized losses can be used to offset ordinary income. And then whatever's left over, that's what carries forward. So you do get an ordinary income deduction of at least $3,000 in certain years. So here's an example. If we have large a large cap growth fund A, if it was purchased for $10,000, a few months later, it's down 50%. That's a bad couple of months. Hopefully that doesn't happen in real life, but for example's sake, now it's worth 5,000. So engaging in tax loss harvesting, we sell large cap growth fund A, and we reinvest that 5,000 in large cap growth fund B. So we're still invested in large cap growth. We just can't have it be identical. That's the only thing the IRS says. So, and it doesn't have to be a fund. So if you own Apple stock and you sell it at a loss, you can't just turn around and buy it the next day. The IRS says that's not fair. So they make you wait a month and a day, 31 days before you can buy it back and actually utilize the loss. So by the end of the year, large cap growth fund B has recovered 100% of the losses, and it's now worth 10,000. So as an investor, you lost no money, but we have $5,000 in realized capital losses. And again, if you don't have capital gains to offset, we'll take a $3,000 deduction of ordinary income. The remaining $2,000 carries forward with us to the next year. So in 2022, the market had a really tough year. We had a bear market that year. So we were doing several rounds of tax loss harvesting in our clients' accounts. For clients who had large taxable accounts, we were, six figures, hundreds of thousands of losses we were able to capture. 2023, the market comes roaring back. We recoup all of those losses, but we still have these capital losses on the books for us. Also last year, bonds, at one point, the 10-year treasury was yielding 3.3% in March. They got all the way up to 5%. And when interest rates go up, bond prices go down. So last year, we had a lot of clients that ended up with 15, 20% returns for the year. But since we tax loss harvested bond funds, they ended the year with capital losses. So when you make 20% in a year and you end up with tax losses on paper, that's the best case scenario. So tax loss harvesting is a great strategy for us. Okay, so now let's talk about some tax deferral strategies. I think the biggest one for anyone who's working is deferring money into a retirement account. So if you're in a 401k, you can do 23,000 this year. If you're over 50, you can add an extra 7,500. So, if you put the full 30,500 in and you're in that 22% bracket, you're saving north of $6,000 in taxes just by deferring that money. Same thing goes for simple 401ks or simple IRAs. You can do 16,000 a year. An extra 3,500 if you're doing a catch-up. SEP IRA contributions. So if you're a business owner and you have a SEP IRA, you can do up to 69,000 or 25% of your income, whichever is less. So if you earn 200,000, you'll be capped at the 50,000, but still nice deferral. So if you're a business owner, we want to see what makes sense for you. Is it a SEP IRA? Is it a simple IRA? Or even a 401k, because what's not on here is you can do profit sharing contributions to a 401k to go above and beyond what this deferral amounts can do. Now, here's a big one. If you're a business owner, you can do a defined benefit plan. A defined benefit plan is kind of that old pension that most workers used to get. That's a defined benefit. You're going to get a defined amount at retirement. But you can set defined benefit plans up as an employer. If you own a business, we like to utilize what's called a cash balance plan for a lot of clients. It's a type of defined benefit. Why we like to utilize that is you can actually combine it with a 401k. So you can do both a cash balance and a 401k all in 1 year. And the contribution limits are far, far higher in those. So if you're a business owner, you have the ability to shelter a very, very large amount of money. And if you don't have any kind of workplace retirement plan, you have your IRAs and Roth IRAs where you can do 7,000 or an extra 1,000 if you're over 50. Some additional strategies, and again, these are very situation dependent, is using life insurance. Most people use life insurance for the death benefit, but if you are a very high income earner and you can really sock a lot of money into a life insurance policy, even though those premiums are made with after-tax dollars, Just like if it's in a retirement account, any accumulated earnings are tax deferred, so you're not paying any tax on the growth within the accounts. And then if it's managed appropriately, you can utilize the cash value pretty much to a tax-free in a tax-free manner. So any money you put in from premiums, you can just withdraw those. You already pay tax on that money. So, if you put in 200,000 over the course of time, 200,000 can come out with no tax. Any growth, you can then take a loan off of. And as long, so you can't take the full amount out because you got to keep some money in there to keep paying the cost of insurance. But as long as the policy doesn't lapse, so you need to manage it appropriately, any loan proceeds you use aren't taxable either. So depending on your situation, that can be a really good strategy. Sometimes with clients, we utilize these for high income earners, and then we take that money out, put it into 529 plans for college for the kids, and then you're getting the state tax deduction on 529 plans as well. Non-qualified annuities as well, like life insurance, any premiums you make are with after-tax dollars. Any accumulated earnings are tax deferred. When you one day withdraw from the non-qualified annuity, it's all taxable until you get to the cost basis, which is the amount you put in. So if you put in 200,000 and it grows to 400,000, the first 200,000 of withdrawals is taxable. And then when you get to the 200,000, then it's just a tax-free return of your premiums. So that would be useful for some clients if you're in high income earning years and you want to just take some of that after-tax money and put it into an annuity, knowing you're going to pay a much lower tax rate in retirement. That could be a useful strategy. So the benefits of this are you're deferring tax the whole time on dividends, interest, capital gains while you're in your higher income earning years. Any income realized later, hopefully we're doing it at a lower rate. If you're just, some people don't ever get to a lower rate, so that's where this probably wouldn't be the best strategies for them, but most people eventually get to a lower rate in retirement when they're not earning income anymore. And then just a side benefit, of course, any life insurance proceeds that go to the family are not taxable. Now, of course, if you utilize the strategy where you have money out on loan, any money out on loan is deducted from the death benefit, but any death benefit that's left over goes tax-free to the family. Okay, so if, I don't know if we have anyone on today's call who's, getting nice executive benefits, but something that's eligible with certain companies to executives and higher income earning employees, that's not to normal employee, lower earning employees, is non-qualified deferred compensation plans. So what that is, it's just a contractual agreement. The employer says, hey, as an added benefit, we'll let you defer some of your income and then we'll pay it back to you later when you're retired, again, hopefully in a much lower tax environment. So you determine how much you want to pay or how much you want to contribute from your salary, bonus, or any other kind of compensation. The nice thing is that similar to retirement plans, you're not paying tax on any investment income in the account. It's deferred. And then ideally you take it out in a lower bracket. So the nice part about these plans is you can normally max out your 401k and then contribute to the non-qualified deferred compensation plan on top of that. And there's generally no contribution limit. So, if you're making $1 million, you can contribute a couple $100,000 to this in addition to what you're doing to your 401k. I know not many folks make $1 million, but in that example. There are, however, some drawbacks from non-qualified deferred comp plans, and that's you do have to schedule distributions. So, when you have money in a 401k or an IRA, prior to required minimum distribution age, you control when and how much you take out of those accounts. In these non-qualified deferred comp plans, you do have to go ahead and schedule those distributions, whether or not you truly need the money. But again, hopefully you're in a much lower tax environment, so it's not a problem. You can't roll it over into an IRA like you can with your 401k or anything like that. So it does stand alone forever. And then I would say the biggest risk is, some companies just aren't that strong financially and they still decide to offer these plans. A 401k, that's set aside separately in trust for the participants of the 401k. So even if the company fails, the 401k money is not at risk. Whereas a non-qualified deferred comp plan, these assets remain general assets of the company. So if the company fails, you may not get anything out of this. So you deferred money, but you're not going to ever get it back. So that's why if you're going to utilize this plan, you want to really have comfort in the strength of the company. Another executive benefit are employee stock options. So in stock options, it's not like the stock options that we can buy and sell and trade, in our own portfolios. Not that we here at Traction do that, but it's different. Stock option, it's an equity-based compensation where an employee essentially gets a grant of a number of shares that gives them the right to buy those shares at a fixed price called the strike price upon a future vesting date. So they'll say, hey, we're going to give you these grants in a year, they become vested, and then you can buy the stock if you want. And the way they set it up is that, hopefully you're going to have these shares granted to you at a price that is lower than what the price of the stock on the open market is trading at when it's able to vest. So if you can buy 100 shares at $100 a share, but the stock's trading for 120, that's immediate gain to you. And there's two different types. There's incentive stock options, which are typically more tax friendly and typically available to, again, more like executives and higher income earning employees. And then there's non-qualified stock options, but they both give you the ability to defer income. And we'll look at some examples here to show why. So for incentive stock options, when you exercise the option, almost always you're not subject to ordinary income tax. There's a holding period that's you need to meet. We'll look at that in a second. But it does count towards alternative minimum tax. Under that Tax Cuts and Jobs Act, essentially no one is paying alternative minimum tax, so that's really not a problem for hardly anybody. For non-qualified stock options, you may be subject to ordinary income. And ideally, if you exercise the option, you will be subject to ordinary income because in that example, you're exercising at a price that's lower than the market price. So whatever that difference is, that spread, you're going to pay ordinary income tax on that. So it's basically like a form of a bonus. And then you can hold the shares and let them grow if you want from that point forward. And those aren't subject to alternative minimum tax. And then when you share the gains or sell the shares, for non-qualified stock options, you'll pay capital gains. So that's where if you hold it for a year after you exercise it, it's at that long-term capital gain rate. For the incentive stock options, it's ordinary income or capital gains. Any gain is going to be taxed at capital gains if it's held for at least a year. Okay, so let's look at a couple of examples. The non-qualified stock options here. Okay, so you get 100 shares. They say you can exercise these shares once they vest at $100, so essentially 10,000 bucks. The market price at exercise when they vest, let's say it's at $150 a share. You say, yep, I like that. I'm going to exercise my shares. You now have $15,000, a $5,000 gain. So that spread, that $5,000, you pay ordinary income tax on that. So $5,000. Let's say you're a high income earner, so you're in the 32% bracket, you pay 1,600 bucks on that. Market price at sale, let's say you wait a year, you sell it later, it's now worth $200 a share. So you get 20,000. Now on the gain from the 15,000, that is now your cost basis when you exercise, from when you sell it, you pay 15% capital gains, that's $750. So you gain $10,000 total. You get $5,000 here from the spread on exercise. You get another $5,000 from growth. So you as the employee, you earn $10,000. You're paying $1,600 on it. $1,600 on part of it and $750 on the other part. Add that together, and that's $2,350. So call it 23.5%. Which is lower than your 32%, and you also spread it out over 2 tax years. So it's a pretty nice benefit to have. assuming your company is doing well and the stock price is going up. Because if they issue this at $100 and the stock's trading at $80, you would never exercise it, because why would you pay $100 for something you could go get on the open market for $80? So it could be a useless benefit if the stock doesn't go higher. Now, incentive stock options, we talked about some holding requirements on what you need to meet. So from the date that they're granted, we'll say these were granted on the 1st of 2022. If the shares are sold 2 years from that date, and then 1 year from the date you exercise it, the whole thing is at capital gains. So let's use the same example, but now it's an incentive stock option. So you get it granted at you for $100 a share. You exercise it a year later. You get that same $5,000 gain. But as of right now, you don't owe any tax on it. That $5,000 gets counted towards alternative minimum tax. But again, you're likely not going to owe anything there. So there's that $5,000 spread. Then we'll say on January 2nd of 2024, you sell it for $20,000. That's a $1,500 a $5,000 gain from when you exercised it. You're paying the 15% bracket, so that's $1,500. So you're paying 15% on that versus what we saw in the other example. So all of it's at capital gains. So anyways, if you have the option to utilize stock options as an executive benefit, it helps defer taxes and ultimately give you compensation at lower rates. Some additional strategies: a lot of our clients own investment properties. So let's say you just don't like your investment property, but you've got your eye on a new one. You can do what's called a 1031 exchange. It's a like kind of exchange. So you exchange one property for another. Let's say you bought a property for $100,000. Now it's worth $500,000. That's a $400,000 capital gain. So if you sold it and then bought a new property, you're paying tax on that $400,000 capital gain. A 1031 exchange lets you lets you have a qualified intermediary hold the cash from the sale of the initial property. The rules are within 45 days, you got to designate a replacement property. You can do up to 3, so long as you close on 1. And then you have to close within 180 days, so about half a year, 6 months. And then now you have a new property that you still have all of those capital gains deferred on. So your cost basis carries over with you. Now it needs to be equal or greater value. And so if you buy a new property for $600,000, you still have to come up with the other $100,000. But the full amount is deferred. If you exchange a $500,000 property for a $400,000 property, well, now there's $100,000. I believe the IRS calls it the boot, and you have to pay capital gains and depreciation recapture, which is taxed at a higher rate on that $100,000 difference. So if you're doing this, you need to do it for a property that's equal or greater value. Now, something that's pretty easy for a lot of our clients who are still working is contributing to health savings accounts, or HSAs. In 2024, if you're single, you can defer up to $4,150. If you're married and filed jointly, it's $8,300. So most of us are going to have some form of medical expenses throughout the year. So if you're going to pay for medical expenses it has to be a high deductible health insurance plan, as it says here, which almost everybody has these days. So if you have a high deductible health plan, you can have an HSA. If you know you're going to spend $3,000 on health expenses throughout the course of the year, put that money into an HSA, and then you can just take it right back out, spend it on the health expenses, and then you at least get a tax deduction on that $3,000. But if you have the extra cash flow, you may as well put up to $8,300 in there so you can get a bigger deduction. And then for small businesses, this is pretty simple and straightforward, but if you want to try to defer some taxes, if you have some expenses at the end of the year that you can just kick over into January of the upcoming year, reverse that. If you have some expenses you need to pay early in the year, of the upcoming year, go ahead and just pay those now while you're in the December, call it, of the current year. So you have extra deductions, and then vice versa. If you have some sales coming through in December, see if you can get that sale pushed over to January to have that count towards the next year. Okay, so charitable giving strategies. We've had to get more creative in charitable giving since the passage of the Tax Cuts and Jobs Act, again, as I mentioned, because the standard deduction is so much higher than it used to be. And I apologize, I didn't say this on the front end. You should see a Q&A chat box on your screen. So any questions you have, please put it into the Q&A section and I'll address those at the end. My apologies for not saying that sooner. Okay, so for charitable deductions, if you give cash to a public charity, you can deduct up to 60% of your adjusted gross income. So if your adjusted gross income is 100,000, you can give up to 60,000 and deduct every penny of it. That's pretty big, but that's the rule right now. If you give publicly traded securities or any other appreciated property, so if you have a stock you bought for 10,000, it's worth 20,000, you can give that stock to a charity, and as long as it's not over 30% of your AGI, you can make a full deduction. Anything that's above those AGI limits, the unused charitable deductions carry forward for up to 5 years, so they don't just go away, so we can utilize those later. Okay, so here's the strategies we are using with clients, because again, if you're being generous, I know the purpose of giving to charity is for a genuinely good cause, but we'd like to get a tax benefit if we could. I just mentioned it, we want to give appreciated securities if we can. So rather than giving cash, let's give some stocks that have appreciated. You cannot do this from a retirement account. It has to come from one of those taxable accounts we've discussed. And then if you have the cash, you can then just put that back into the portfolio, buy what you just gave to charity, and now you're resetting your cost basis higher. So it's a win-win on both sides of that transaction. But yeah, you're avoiding the capital gain that you would have ordinarily realized had you sold the investment. Because charities get it, they sell the stock or whatever you donated, and they don't ever owe any tax. So we completely cut the government out of that. If you're 70 and a half, you can do what are called qualified charitable distributions, or QCDs. They used to have it line up with the required minimum distribution age, but then they pushed it out to 72. Now they pushed it out to 73 for some folks and 75 for other folks, depending on the year you were born. If you're born in 1960 or after, now it's age 75. But they kept this at age 70 and a half. So, let's say you don't have any appreciated securities to give, but you want to give and get some sort of tax benefit out of it. You give it straight from your IRA to a qualified charity. They're not considered taxable distributions, and you can do up to 100,000 per year. So, you're not getting a tax deduction for it, but it's essentially the same thing as a tax deduction because you're taking money out of a retirement account that would normally be a taxable distribution. So it's a really good strategy once you get to age 70 and a half. And then we are using this more and more now. They're called donor advised funds. So it's a private third-party administered fund created to manage charitable donations on your behalf, or you can do it for an organization or a business as well. Now, LPL, we have several clients that have donor advised funds with LPL. So we can help manage these. You put contributions into the donor advised fund. Think about it kind of like a charitable IRA. You put money in, you get a dollar for dollar deduction for what goes into it. That money can then be invested, so it grows hopefully, and more money ultimately goes to charity. Now, any growth does not provide you with any extra deduction. You only get a deduction for the amount that goes in. But you can put cash in there, or you can put appreciated securities in there. So, just like if you're going to give appreciated security directly to a charity, we want to use, if we can, appreciated securities to go into the donor advised fund. You then avoid the capital gain and you get that tax deduction. And the reason donor advised funds are becoming more and more popular is because, we have a little example over here we'll run through. If you give $10,000 to charity, there's a good chance you may not be able to itemize deductions still. And so you're not going to get any tax benefit for it. So due to that, we're using what we're calling the bunching strategy, to where we're going to bunch a couple, 2, 3, maybe even 4 or 5 years worth of charitable giving all into 1 year. So we're at least going to have enough to itemize and get a tax benefit in 1 year versus no years. And again, we want to try to use appreciated securities if possible. If not, cash is totally fine. So in this example here, these folks do $10,000 a year in charitable giving. All of their other itemized deductions add up to $13,000, so $23,000 total. But in 2023, the standard deduction was $27,700. So they got zero tax benefit for it. So, and same thing if they did in 2024,000 standard, or 2024 standard deductions even higher at 29,000. So they're going to get 56,900 through their standard deductions. But what happens if they did 20,000? So they took 2 years worth, did it all in 2023. And again, you can do this all straight to charity if you want. We like to do it into a donor advised fund because a lot of folks say, well, I don't really want to give it all to them this year. So we put it in the donor advised fund, and then you pay it out of the donor advised fund annually, just like you would have if you were giving it straight to the charity. But now they have 33,000 in deductions, which is above that standard deduction. So just by doubling up, they're getting an extra 5,300 in deductions. So it's a very worthwhile strategy if you're doing charity and not able to itemize deductions. We want to use this bunching strategy, whether we're giving it straight to charities or putting it in the donor advised fund, because a lot of folks give to their charities on a monthly basis or to their church on a monthly basis. You can set up monthly, quarterly, annual, automatic distributions from the donor advised fund. So you can set it up pretty much however you want, or you can do one-time grants out of a donor advised fund. Okay, here's a really neat strategy that I've used with a handful of clients now. It's called a charitable remainder trust. So what a charitable remainder trust is it's an irrevocable trust that generates an income stream for the donor or beneficiaries potentially as well. And the remainder of the assets go to a qualified charity or charities of the donor's choice. So I've done this both ways, where I've had a client put money in using a highly appreciated security or a highly appreciated property. Let's say you're tired of being a landlord, but you don't want to pay the capital gains tax. So you sell your investment property. This is a great tool because you're converting it into an income stream. So you are paying tax on the income, of course, most of which is the capital gains that you avoid, by the way. But you're spreading it out over the course of time versus hitting you with a massive capital gain all in 1 year. And then I've also had it with where, a parent does this and then they just make the kid the income beneficiary. So it gives their kid some extra income. So there's 2 types of charitable remainder trust: a charitable remainder annuity trust, which is you distribute a fixed annuity income stream each year, and you're not allowed to add anything else to the charitable remainder annuity trust. So you put $1 million property into it. Let's say you want a 6% annuity. You're going to get your $60,000 of income year in, year out, but it's a one and done deal. And again, this is irrevocable. So once you do it, there's no going back. Or you can do a charitable remainder unit trust. It distributes a fixed percentage based on the ending value at each year. So it's revalued annually. And you can add more to it. So let's say, same example, you put $1 million into it. You want a 6% payout. That first year, you're going to get your $60,000. And then the money, once it's in the trust, it's invested. It's generating interest, dividends, and hopefully capital gains. And so let's say you have your 6% paid out, but the portfolio within the trust earned 10%. Well, now you have more at the end of the year than you started with. So 6% for the following year is going to be a higher payout. So it's no guarantee that it happens, but this is one way to try to not have a fixed income stream that hopefully uh, maybe grows over time, helping keep up with inflation a little bit better. And you can you can add to it later on. So I've had clients that have, 3 rental properties, they put one in, and then a year or two later, they put another one in. So it's just a great way to avoid the capital gains. You then get an income stream and you get a massive charitable deduction. So as the graphic shows, you put the charity in the contribution in the charitable trust. You then have an income stream paid out to you and or your beneficiaries. And you can set up to where I want it to pay me and for 20 years. And if I die in the middle of that, you still are having it pay out to a beneficiary. And then at the end, it goes to the charities of your choice. So here's just an example. You put an asset in there for 500,000. The cost basis of that asset was 100,000. So we're avoiding a $400,000 capital gain. We'll say that the donor and the income recipient is 60. They want a 6% payout. So in the first year, they're going to get 30,000. Again, that's going to vary depending on how much is in the trust at the end of every year. But the charitable deduction, it's the present value calculation of what's expected to be left to charities at the end. So you're getting a $164,000 charitable deduction. Now, again, if you can't, that might be more than the 30% of your adjusted gross income. So it'll carry forward into future years if you can't use it all. Or we'll look at a different strategy here in a moment. We want to use that if we can, and I'll show you how we do it later. So additional tax planning strategies. Again, this is for business owners. So I don't know if we have any business owners on the call today, but that Tax Cuts and Jobs Act, my favorite part of it is it created what's called the Section 199A Qualified Business Income Deduction. What it does is it allows a 20% deduction for people that are small business owners that are pass-through entities. So if you're an S corporation, an LLC, a partnership, or just a sole proprietor, you can get this 20% deduction basically on your net earnings. So a business owner has the below threshold. There is phase-out ranges. So in 2024, if you're a single filer, once you hit $191,951 of qualified business income, so not gross sales, but qualified business income, it starts to phase out all the way up to, we'll just call it 242,000. If you're married, it goes up significantly. It effectively doubles to 383,900 to 483,900. So some of those tax deferral strategies we looked at earlier, they come in really handy. So if you're a business owner and we set up one of those defined benefit plans, you were making $500,000 of qualified business income, you put 120,000 into your cash balance and 401k plans. Now you're under this limit, you get your full 20%. Now, if you're a specified service business, that's a doctor, a lawyer, a CPA, a financial advisor, basically anyone who's kind of consulting and not selling a product, or they have up till this phase out range. And if they're in it, and once they eclipse it, it's eliminated completely. There's no coming back. There's no way to get it back. Now, if you're not a specified business, so a specified service business, once you exceed that upper threshold, you can still take a deduction equal to or the lesser of the greater of these two items down here. So 50% of W-2 wages paid by the business. Not only do I like how small business owners are getting a 20% deduction, but it incentivizes hiring and paying W-2 wages. Or 25% of W-2 wages paid by the business plus 2.5% of the unadjusted basis of a depreciable property owned by the business. So if you're a business and you own a building and you bought it for $1 million, 2.5% of that can be counted towards as well. So that part really helps out like real estate developers. Okay, so let's look at an example. Section 199A, Gary, he's a sole proprietor and he's not a specified service business. In 2024, he's projected to have $750,000 of net profit for qualified business income. Since he's a sole proprietor with no W-2 income, he's well above that upper threshold that we looked at. He's getting $0. However, Gary is smart and he works with a firm like Traction Financial Partners and a good CPA. And we say, let's convert you to an S corporation. So that way you can pay yourself a W-2 salary. We go with $214,275. I'll explain why. That leaves a net profit of $553,000. Still above that threshold, but we can bring in 20% of that qualified business income is $107,000. We can bring in that W-2 income he just paid himself. All he did was change his business structure. He's paying himself a salary now. And so 50% of that is $107,137 and change, almost exactly the maximum 20% amount that he can contribute. So that's why we went with this amount. That's 28.57% roughly of that 750,000. It's just that they call it the magic 28.57%. So if it's not as easy if you have employees because you're paying them income as well. But if you're a sole proprietor, however much your net profit is, pay yourself 28.57% of that as a salary. You're going to maximize your qualified business income deduction. So as we saw, Gary's a high income earner. He's in 37% bracket. That deduction that we got him that he got $0 of now saves him $39,640 and change in taxes. Oh, on top of that, he saves FICA taxes, which is payroll or Social Security and Medicare taxes, because that's only owed on W-2 income. The Social Security wage base for Social Security taxes is $168,600. His salary's higher than that, so he doesn't save anything there. However, there's no cap on the 2.9% for Medicare taxes. He's the employee and the employer, so he pays both halves of that, 1.45 as both. Therefore, he wouldn't owe 2.95% on that other amount that's not being paid as a salary, saving an extra $15,000. So just by changing the structure of his business and paying a W-2 salary, he's now saving upwards of $55,000 in taxes that he wasn't otherwise. So a great strategy for business owners. I know everybody on today's webinar may not be a business owner, but if you know any and they need this kind of planning, this is a great approach. Okay, our final strategy here is a Roth conversion strategy. So a Roth conversion, and we do this with a lot of clients, it's you transfer assets from a pre-tax retirement account, so your IRA, your 401k, your simple or SEP IRAs, into a Roth. The amount converted is fully taxable in the year it's converted. So you may say, well, why would I want to just pay tax on something that I wasn't going to do? We'll explain why. Each Roth conversion must abide by the 5-year rule. So every time you do a conversion, you want to wait 5 years before you take that out of the IRA, because if you touch it before that, and it's prorated based off of where you are in those 5 years, it's a 10% penalty. And it's per tax year. So with people that we do conversions with, a lot of the time we'll do it in December. That counts for the whole first year. So really it's like 4 years and a month. But we want to be sure that, when we're doing this, we're trying not to touch it for 5 years if possible. So here's an example. 65-year-old, married, filing jointly, is estimated to be in the 22% bracket when RMDs begin at age 75. So when she hits 75, she's expected to be in the 22% bracket. Other than a small Social Security benefit, she has no other income. Her IRA is worth $1 million. So now let's say we assume we can convert $50,000 a year for those 10 years prior to RMDs kicking in. And let's say we're able to do that while keeping her in the 12% tax bracket. So we converted $500,000, which is now in a tax-free Roth forever. So in total, at 10% lower rate, we save $50,000 just on the conversions. We also have we have $500,000 that's no longer in the IRA. So her RMDs are going to be half the amount, much lower. So that's going to save additional taxes that she wouldn't have saved had she had the full amount there. And then later in life, we can start utilizing those IRAs once those 5-year clocks are up. We can start using those Roth IRAs, saving even more tax that she would have had to pay tax on distributing it from her IRA. So we're able to save 50,000 just on the conversion, but we run plans for folks when it factors in all these other items, and we're saving. It's projected to be saving millions of dollars in lifetime taxes sometimes. So that's why we're fine contributing to our 401k pre-tax while we're working, because we can just convert it at a lower rate later. So it's a really great strategy. To wrap this up, we talked about that charitable remainder trust. A lot of folks say, well, that's irrevocable and I'm disinheriting my kids. Well, we saw in that example how we had $164,000 of charitable deductions. We're going to use that. We're going to offset some of these Roth conversions. So in this example, the first 3+ years of Roth conversions, completely tax-free because we got that deduction. And so now you're re-inheriting the kids through the Roth IRA, and it's a completely tax-free inheritance. So, that's the other benefit to these, whether or not you have that charitable remainder trust, because that's a unique strategy and doesn't work for everybody. But now whatever's being left to the kids is a much more tax efficient estate, and it's tax free. So that is going to wrap up our strategies. There are certainly other tax strategies. I know I just threw a lot at you over the course of the last hour. But we highly encourage you to reach out to us to see if any of these strategies make sense for you. And we will coordinate with your CPA as necessary to make sure they do work for you. So with that, I'll open it up for any Q&A. So far, we have no questions, and that's not a problem. I'll give it a couple minutes to see if anybody has any questions they want to come in. But if not, feel free to reach out to us after the fact, and we'll be more than happy to run through everything with you and see what makes the most sense for your situation. And while we're waiting to see if any questions come in, I did want to do one other thing. I'm going to share my screen here to let you know some other webinars we have coming up. So, today is our tax planning strategies webinar. We're going to continue to do our quarterly market and economic update webinars. So those will always be within, call it 3 weeks of the end of a quarter. But in March 19th, we're going to do a Social Security webinar, getting the most out of your benefits with Randy Anderson, one of our wealth advisors. Randy is an absolute Social Security wizard, so you're not going to want to miss that one. It is really, really impressive, the types of strategies and knowledge that he has in terms of Social Security. So keep an eye out for those invites. They'll probably be going out within a couple of weeks or so, because that's about a month out. And then I didn't touch on estate planning today, because there's, of course, tax considerations for estates. So estate taxes, we in May are doing an estate planning webinar, where we'll definitely be sure to touch on that as well. So keep an eye out for these invites as we go throughout the year. You can see we're going to do a healthcare and long-term care planning webinar in August. And then we're going to do later in the year, we're going to kind of peel back the curtains and let you know what the Traction Investment Committee does on a monthly basis. We have an investment committee that meets once a month. So we'll kind of peel back the curtains and let you know everything that we're looking at and staying on top of to manage your portfolios for you in the best way possible. Okay, so I don't see any questions coming in. Thank you so much for your time today. We really appreciate it. We know how valuable your time is. Again, follow up with any questions you may have. And with that, wishing you all a very wonderful rest of your Wednesday, and we'll talk to you all soon. Thank you so much. Take care.